Good morning. I had to think about what time of the day it was then. We're still in morning, aren't we?
Yep.
Cameron Murray, Leith Van Onselen from Macro Business. Cam from your very successful Substack, Fresh Economic Thinking. Obviously, I've interviewed you both individually over the years, and I thought it'd be really good to have a threesome, so to speak, between us.
Wow. Hey.
Spicy already.
Oh,
Leith's just come back from the gym,
Yeah.
so feeling all fit and flexible. Cam's too intelligent, you know. Mind you, Cam, you are a rock climber. I should.
I yeah, I did go to the climbing gym this morning. That's why I got wet hair. I've just had a shower to get ready for this.
Yeah, it's just like I said. We should start an OnlyFans page and
Oh.
earn a few extra dollars. I reckon with you two going to the gym and being all fit and
Yeah, got to diversify, Catherine.
But more importantly, what I thought we could discuss today is what's going to happen. Because I thought what was really interesting was they had a 60 Minutes program on a few days ago, right? And
Mhm.
I actually didn't watch it. I can't watch housing stuff that's calling for a crash because 60 Minutes and Four Corners, they don't have shows that say there's a boom coming. They only have shows that are going to be a bit clickbait. So they get someone on that's in the general theme of like a Harry Dent, which is, you know, doom, gloom, housing market's going to crash. These are all the reasons why. And because that's not what I'm seeing for 2025, I feel that the probability of a very strong recovery in housing markets is there. It may be a moderate recovery in some areas of Australia. It may be a strong recovery. And also talking about what's occurring overseas of those types of trends that are pushing that. So I'd like to do
Mm.
a little bit of a reverse of 60 minutes. Maybe we can have a
Yeah.
discussion about it, which is a little bit more kind of balanced and intellectual about what could happen over 2025. And I know, you know, we're three people with very strong opinions. So where should we start? There's a lot to talk about. I'm desperate to sort of dive in, but maybe we will start with where we were just discussing before I clicked record. Um,
Hmm.
informed everybody that you've just got back from the gym, but maybe we start with interest rates because that impacts everybody, and of course has a major impact on building activity, more
Yeah,
rates,
it does.
and everything else. So where should we start? Leith, do you want to
Yeah.
delve in? You were the
Yeah.
one, Leith, that said to me a year ago,
December, I think.
earlier this year, that rates there would be a rate drop this year.
Yeah. It was looking less likely now. I think it was December last year. I mean, I tipped the second half, but it's looking a lot less likely. If you look at the Reserve Bank's minutes that just came out, they seem to be pretty hawkish. And, you know, inflation's been more stubborn and the labour market, at least officially, is held up, you know, stronger than what the Reserve Bank had thought. So a lot of that's on the NDIS type jobs. So, you know, we have a pretty interesting economy at the moment whereby the private sector is basically in recession.
Mm.
Um, and the economy is, well, actually, the overall economy is in recession if you look at it in per capita terms. But, you know, it's obviously been held up by still strong population growth. And we've also got enormous amount of public spending. So hilariously, the labour market account, which is a quarterly update from the ABS, it's only, I think, for the March quarter, the most recent one we've got. The June quarter hasn't come out yet. But that showed that the entire market sector, just based for the private sector, only increased jobs by 6,000 in the year to March. And the number of hours worked across the market sector actually fell by 20 something million. But the non market sector, which is basically all the government aligned stuff, had strong jobs growth. And a lot of that was related to aged care, NDIS, that sort of thing. So we have a sort of funny economy whereby the private sector is getting hammered, and whereas the economy's been held up by obviously, you know, massive government spending, NDIS type spending, as well as obviously this very high, strong immigration that we still have. So it's
Mm.
kind of it's a weird economy. It's a weird labour market, and all those things sort of, and the Reserve Bank's own statements suggest that interest rates aren't going to come down this year, and they've been pushed into probably early next year. But we don't really know. We just got to see how the data plays out. I actually think the Reserve Bank's been pretty sensible. They basically said they're not giving a definitive, you know, push either way where interest rates are going to go, but they're basically said they're going to watch the data and see how the data falls. And if it comes in, if it weakens, they'll probably cut. If it doesn't, they'll remain on hold. I think that's the most likely. But this comes at a time when a lot of our, competitor nations or nations you usually compare Australia against are actually cutting interest rates. So Reserve Bank of New Zealand cut interest rates last week. Bank of Canada's cut twice. We've got cuts in Europe now. So Australia is sort of the laggard now. We're behind the ball, but our inflation seems to be a little bit stickier, and a lot of it's domestically driven inflation. And on macro, we've often talked about, what we've termed cheekily, like, it's been a bit cheeky, elbow inflation. So we've had very strong growth in rents, obviously because of the high population growth mainly. That's starting to come off, at least with asking rents, but the CPI rents is lagged, so that's going to keep rising for a bit more. And then obviously we've completely stuffed up energy policy in this country, which has put upward pressure on gas and electricity prices, which has been pretty stupid. And we've turned a comparative advantage into a disadvantage, and that's also pushing up cost pressures across the economy. And the government's trying to paper over those with subsidies, but in the end, that's also structural, structural driver of cost push inflation. So I think interest rates, to cut a long story short, we're going to have to wait till probably early next year, but we'll just have to see how the cards fall.
Cam?
Yeah, that's right. It is interesting, right, to see how much New Zealand and Canada, for example, have already had recessions. Like where Canada's in the middle of a recession. I've called the last 10 years in Canada the lost decade, right?
Shocker.
It's crazy. And then I think New Zealand have had, is it 6 quarters of negative GDP per capita growth? And I'm not sure about
and deeper than Australia.
That's right. Yeah. So that we're actually getting a lot of net migration from New Zealand to Australia now, just because the economy's tanking there. I think you've got to keep in mind a lot of these patterns we're seeing globally in this cycle, I think are due to the different way monetary policy transmission works, right? So Australia has variable mortgages, but in some ways that sort of helped a lot of people get ahead during COVID when the mortgage rate came down. So there's sort of fewer people now with high mortgages. The US is sort of still stimulating, right? Because when they raise interest rates, you don't have that sort of cash flow effect on mortgagors, right? Because they can keep their fixed 2% interest rate. So the US is still sort of humming along a little. I mean, we've seen the SARM rule trigger, which is like a recession indicator that unemployment is rising. We've just seen revisions to some of the labor statistics. But it's a really weird situation. As Leith said, I feel like we're having this rather than a real shock type recession. We're having a sort of post-COVID sort of slow motion recession that's happening. And so I guess some countries are further along, and so they're cutting, and Australia is not quite there yet. And I mean, we all raised interest rates to try and stop people building houses, right, and spending money, and make more people unemployed. And it's kind of started working now. So we're going to have to reverse that. I suspect the next little while, we've already had a big adjustment. I suspect we're going to see a bit of a bounce in sort of building approvals and things like that next year if we follow suit and start, cutting interest rates a little as well. You can see that in the history. I was looking at some data yesterday. In the 1990s recession, we had a big jump in, dwelling approvals and commencements, right in the middle of the recession. We had this sort of launch while other parts of the economy were contracting. So yeah, it's an odd time. Interest rates in Australia probably, I think Leith's call was probably a little bit, ahead of its time. I think Australia is going to have to wait another 12 months before we really see these effects that are happening globally happen here. What do you think, Catherine?
Well, I can't comment on anything without taking the cycle into mind. I feel like we have to have a look at a cycle that has got solid evidence behind it and has been accurately predicting market downfalls for over 100 years in US data and in European data, and also Australian data. If we look at the dates of our significant housing downturns, they've come as per you would expect on that cycle. So every time I look at something, I think, okay, the cycle gives you kind of like a roadmap. and it gives you a bit of an accuracy in terms of when you can expect there to be a trigger point for a market crash. But at the same time, how it actually plays out and applies to a local economy, you have to look at those fundamentals. So I look at the two regarding there, and it's not just the property cycle, which I don't think that we can deny. I mean, obviously I don't deny it because that's what, you know, my writing work is based on. But I think the evidence gives some kind of solid thing that there is such a thing as cycles and timing cycles. And then also, you know, the Kondratiev cycle, which is a commodity cycle, which does actually forecast inflation for this decade, and that's played out pretty accurately. So inflation in commodity prices, it was what enabled me really to say that Perth's market was going to explode in the second half of this cycle, which you would see between around 2021 to 2026. And commodity prices were going to have a big uptick, which of course is why Perth's market is doing so well. The only time Perth really gets population growth is when its mining industry is thriving, because it's such a town. That's the thing that sort of attracts jobs. The unknown and the things that are unsure in this cycle are to do with the rapid rise that we got, a rapid and historic rise in rates so early on, which now, of course, is impacting economies, which is causing them to drop rates in light of a weakening economy. And okay, you know, sort of Australia isn't there yet. But what I wonder might happen is really based on the other element that the Kondratiev cycle always seems to feature in that upwave of commodity prices, which is war, which goes kind of with that, you know, challenge of controlling the trade routes and controlling the supply lines. And we saw China obviously has been gearing itself up for that for a while with the Belt and Road project. That scaled back a little bit. They're, you know, but that was all about opening up different supply routes so that they could maintain some kind of dominance in the market. And then, of course, with the war that's happening in Europe and the Middle East, you know, that's really impacting supply lines as well. We know that Iran wants to control those supply lines that are essential and run through the Middle East. That's really what this war is about. You know, it's not so much about, you know, what people are the main focus of what people are looking at, you know, Hamas, Iran's proxy. So the way that I kind of see it is, are we going to get caught unawares with this? You know, that countries are going to lower rates. They're looking locally. How can they save their economies locally? Like you said, we've got these recessionary indicators, which aren't such good indicators anymore. The yield curve indicator is getting upset because of perhaps yield curve control. And, you know, the SAM indicator has come out. But even the creator of that indicator said herself, it might actually be wrong. Don't take it as, you know, read, because it's been, you know, we've seen some unusual things happen in labor markets. So could it be that we have a fall in rates and then war escalates further, which it is, and supply lines get impacted further, and we suddenly face a situation where we have inflation taking off, and the only way that central banks can control it is with rate cuts? Because if we get a fall in rates, so I mean, I guess this can bring us on to our other subject, which is you know, obviously the US and everything have cut. That the US is on fixed rates, right? So obviously they fix their loans in the housing market. But even so, for new buyers, the rate probably would come down closer to 6%. I think it's in the high 6% at the moment. By the end of the year, we probably would expect that to happen from the rate drop. That's obviously going to impact property markets even more. But if the only way that they can kind of control the inflation is through putting up rates, if we reach that scenario, then they've got to do something else to push their economies. And in these economies that are choreographed around the housing market, with multiple industries making their money when property prices inflate, then you have to think that the only way that you're going to buoy those economies, therefore, is through incentives, which is precisely what we're seeing gearing up in the US. So let's move the focus onto that for a minute. Biggest economy in the world still. We're watching the bizarre US elections play out like the best comedy act you ever seen. You know, the Biden and Trump, I don't know whether you spend much time on social media. I probably spend way too much time scrolling through TikTok once I've finished all my work and stuff in the evening. But just seeing the skits and everything that have kind of come over that period. And now in comes Kamala, you know, and she's galloping up to meet Trump. And of course, lo and behold, what are her property policies? Well, they're just so inflationary, more so than Trump's. I mean, she's got this, you know, first home buyers grant. She's got a relaxation on zoning. Trump is very protective about zoning. So she's like, we'll relax all these zoning laws and, you know, get rid of all the yimbys and everything. So it's just like a classic act for whatever happens in 2025, even if they find that they've been a bit upset with inflation, which might ultimately crash the property market at the right time, which is I'm sort of predicting between, you know, mid 2026 into 2027. But that timing, I feel, is pretty secure, honestly, for the US to go into recession. So, which means we've got a bullish year to sort of come. So yeah, I'm kind of interested in people's opinion on that. I know, Cam, you're desperate to get on the bit of that one because you were the one who put the thought in my mind yesterday when we were, you know, teeing up for.
Really?
But yeah, where you sort of, we were sort of thinking, what can we discuss, you know, that's going to be relevant. But Leith, do you want to have a uptake on that subject? What are you seeing in terms of what the US election outcomes could do to the economy?
Look, I'll be honest. I have barely followed the US election. I find it mind-numbingly boring, I guess. Like I kind of, you know, a couple of weeks ago or a month ago, whenever it was, when Trump got shot, I was, you know, followed it a little bit, but I haven't been following the Kamala Harris stuff at all. My business partner Dave sort of tracks that stuff. I can't be bothered, to be honest with you. And honestly, if I have to say one criticism of Australia is that Australians seem to care more about what's going on in all these places than they do in their own country. So this is going off a little bit off topic, but you know, the amount of people I see who follow the US election like a hawk, whilst they ignore all the stuff that's going on at home, sort of, I find that a bit irritating. I wish people would stand up more to what the sort of egregious stuff that's happening in Australia on, you know, energy and all sorts of stuff. But yeah, look, the US is obviously going to have uncertainty until the election. And then after the election, the uncertainty is going to drop. And that should, one way or the other, you'd expect it to have a positive impact on the US economy. That's, I guess, the big picture thing. Whether or not, like, the US economy has been humming along pretty strongly. It's actually had productivity growth, whereas the other, you know, Anglo nations have all had appalling productivity growth. Its living standards of, you know, are rising based on that, even though most of it's going to the top. That being said, you know, a lot of its economy and is very narrowly based, you know, around tech and everything else. So we had a huge tech bubble that's gone up with all their, you know, Microsoft, Nvidia, all these companies have gone through the roof. I think that's going to unwind at some point. So yeah, in terms of next year, I don't know. We'll have to see how we go. I don't really have much of a view on the US economy, but the conclusion of the US election can only be positive, I think, because it'll get rid of some uncertainty. Cam's probably got more of an opinion than me.
Oh, look, I don't think I disagree with anything, especially, you know, following our own politics a bit more closely with a bit more scrutiny. Something you do every day, Leith, give everyone a hard time for their dodgy policies down under. Yeah, so I think you're right that there's a bit of uncertainty. There'll be a bit of investment just sort of waiting for some you know, an election decision there, so they know, you know what sort of policy agenda you'll be operating under for the next 4 years. I think the big picture in the US is just that they had such a big correction after the last cycle in the financial crisis that any correction today is going to be very small in the US relative to Australia, Canada, New Zealand, that didn't wipe off any leverage from household balance sheets after the financial crisis. Are sort of more heavily reliant on China, which is having a big property market correction at the moment. And so I think we're going to find, just like during the GFC, which was very concentrated in the US, Spain, Ireland, you know, but not very much in New Zealand, Canada, Australia, relatively speaking. I think we'll find the reverse of that this cycle. And I think that's, you know, already emerging in this, you know, shallow but long recession that is happening in New Zealand, Canada, UK, etc. So yeah, I guess in general, yeah, the US will continue to hum along relative to those countries, I suspect, in the next couple of years. And yeah, I mean, it could even surge again. I mean, their adjustment after COVID to opening up was very rapid, right? They had inflation went up a lot, but it came back really quick, right? So you can see the spike in rents went up, then rents fell again, and now they're almost through to the other side, right? Whereas Australia is still 18 months behind in terms of getting that inflation to wash out, getting those adjustments to happen. So yeah, the election, hilarious comedy show, but Australia's elections can be a bit like that, but are probably more important to our sort of day-to-day lives for sure.
I mean, yeah, look, I think it's always worth looking at what's going on in the US because, ultimately they kind of lead this cycle. They're such a big economy that, when it all ends for the US, it kind of all ends for everybody else, around it. If you're looking at the stock market going, which contains a lot of real estate wealth, building companies, banks, and even on a company, company assets are quite a lot built from real estate wealth. So, I always think it's worth keeping an eye on it, but kind of bringing it close to home. It's interesting in regard to rents, which do have an impact on inflation. And, this is kind of like where Leith's sentiment sort of comes in with the local things that have happened over the last few years, because we've had this massive rise in immigration into housing markets, into areas which are naturally limited in supply. We know that there is an abundance of land in Australia, but there's only so much land that provides you access to the jobs, access to schools and parks and all of those things that people coming in do require in order to survive. And because those markets are naturally limited in supply, particularly so when you've had rapid inflation, which means a rapid rise in building costs, rise in interest rates to accompany that, which means making it very unprofitable for building activity. And the inevitable happened of what anybody would have been able to forecast, which is an enormous increase in rents that we haven't seen for a number of years. It's not that we haven't had tight rental markets in the past, but the individual stories, of course, are the ones that kind of highlight the most. The individual stories of people. I mean, I know, people in Sydney where their rent went up from 500 a week to 750 a week for a one bedder, in one go. They just that was the price, and you either pay it or you get out and you look elsewhere. And of course, you can't debate it because looking elsewhere, the rents are just as high. I'm a rent investor, so I rent where I live. And I've kind of experienced pretty similar myself, to the point that I'm thinking, okay, it might not be sort of worth this strategy at the moment, because they're still occurring in Melbourne. We're still seeing rental rises in Melbourne. So SQM data came out for the first time. It shows that there's been a slight reduction, that it's slowing up, right? It can only go up so far because rents are tied to wages. And, at some point people are going to start doing what they're doing, which is the rise of websites such as Flatmate, sharing websites. We're seeing multiple instances, and I've seen this particular, rooming houses have taken off. And so I have a lot of investors that I deal with that are looking for rooming houses. They're searching for yield, and that's one aspect that they're looking at. So people teaming up together in order to reduce rental costs. What's going to happen going forward? Well, are we going to get that building boom for a start that you're talking about? Because that kind of plays into it. One thing perhaps we can swing on to after a discussion about rents is, actually, I'll leave that. I'll come back to that because I'm going to muck up the smoothness of these subjects a little bit too much. But let's weigh in on the rental stuff. Leith, what are you seeing in the data?
Okay, so basically, if you look back to 2008, the global financial crisis, Australia had what was then a big surge in immigration. It was the record, and rents rocketed up. And then over subsequent years, the rents tapered off, and then they actually, we had falling growth in rents over the next pretty much decade, and that happened as immigration moderated, it sort of got to a steady level of about 180 to 240 a year, sort of up and down like that. And we had a supply response. We had the massive high-rise apartment boom that happened between 2015 and 2019. And so supply caught up, rents moderated, etc. A lot of that supply, I'd say, was terrible. It was crappy. It was that high-rise dog boxes, that flannel cladding, building defects, balcony problems, Opal Tower, Mascot Tower, etc. It wasn't particularly high quality, but it did obviously, flood the market with supply, and that helped to bring down rents. And then this time around, we've obviously had another record spike in immigration, but way bigger than the last one. Basically 1 million net migrants in 2 calendar years, unprecedented level. At the same time as we've had obviously high interest rates, construction costs have gone up. We've got 3,000 building firms went broke in the last year. Builders are competing for big build infrastructure projects for labour, et cetera, and materials, et cetera, et cetera. So the supply side is constrained. And as a result, we've had, massive influx of demand through immigration into a supply constrained market. We saw a 30% increase in rents over, 18 months or 2 years, whatever it was. And now immigration is starting to taper off. And as you said, households are responding by moving into group housing, et cetera. They're economizing on rent. They're trying to move to more affordable areas. They're staying at home for longer, et cetera. And as a result, asking rents are falling. Or at least the growth rate's falling. Depends on which measure you look at, but it's tapering off. So it's kind of a repeat of what happened in 2008. Now, the big question is, how much is immigration going to fall? So I think it's still going to be elevated compared to the last time around in 2008. But also, will we get the construction rebound? So I think as Cam said, we definitely will get a construction rebound when interest rates start falling. We always do. The problem I see is that we've actually, construction costs are structurally higher now. So construction costs have basically gone up 40% since the pandemic. And unless we actually get deflation in construction costs, they're still going to remain structurally a lot higher than they were before the pandemic. And that could limit the quantity of building. Because at the moment, building a new home is just incredibly expensive. And that's a natural, that's going to naturally curb the supply response. So I can see us still not building enough homes for the amount of population growth unless we cut immigration, unless immigration comes off fairly hard, which I hope it does. And that doesn't necessarily mean we're going to get this rampant rent inflation we've had, but it could mean that rental vacancy rates remain fairly tight and we have still, above inflation rent growth. They mightn't come off as much as they did last time around. But we'll have to wait and see. It is an inequality disaster that we've had. We've had obviously, a 30-odd% increase in rents. That's never good. It's especially not good when the people that are impacted by that tend to be, lower income, younger, poorer, etc. So it's not great. But the good news is, as Cam mentioned, asking rents, at least according to SQM, are starting to fall. CoreLogics have basically, eked out 0.1% growth for the month. They've had their lowest growth rate for, 2 years. So it looks like the rental pressures are at least, being mitigated. And part of that does reflect the sort of move into group housing, the response from households. And there's one important point to make here. You can't leverage rents. So unlike mortgages, where you can borrow into the market, rents are really more of a pure supply-demand, measurement. And they're dependent on income growth, and they're also dependent on, I guess, supply relative to demand. And you can always impact demand by, moving into group housing and adjusting that way. And that's sort of what's happening at the moment. We're not building enough homes for the population growth, but at least, households are economizing on rents at the moment. I think that's what we're seeing.
Cam?
Yeah, I mean, all of that is, I think, exactly spot on. It is a little bit of a repeat of that post-financial crisis quantitative peopling, whatever the phrase we use is open the borders, try and stimulate the economy. And then, unfortunately, that costs a lot of people who have to compete in the housing market. But then that subsequent decade and the next building cycle, as long as that immigration tapers off, we can usually converge again. I think to add a little bit of a different angle here on what we're seeing for rents in Australia, we've got to understand that that rising rents in the last 18 months have actually vastly outpaced rising prices in most cities. And so the yields for buying houses have risen, right? So let me look on live on SQM. I got here sort of implied gross yields for units in Sydney have come up from around 3% to 5%, right? Because unit prices haven't risen much, but unit rents are up, say 40% in the last 2 or 3 years. And so yields are actually quite okay. So I think if we're going to keep in mind what's coming for prices in the next cycle, we're not at an abnormally historically low yield point where, there's a lot of risk to the asset price, right? The asset price is high because the yield's like 2 or 3%. And it can easily drop by half if the yield goes up to 5%, right? But depending on, macro conditions and monetary policy settings, we're already through a bit of an adjustment that sort of justifies higher prices. So in terms of the next price cycle, I suspect, it's not going to be a big crash. People who are predicting substantial crashes kind of have to explain why yields at 5% in Sydney apartments, for example, are going, if you think prices are going to fall 30%, yields are going to have to rise to above 6%. So you're going to end up with an over 6% yield. And of course, if prices are falling, we're going to decrease the interest rate,
rates.
right? So my point being, the rising rents have now sort of retrospectively justified some of those low interest rate prices from COVID. And we've sort of adjusted back a lot of the way from what looked like overpricing at these high interest rates to something that seems more sensible according to sort of asset pricing, where the yields are a bit higher. So that would be my sort of cautionary tale for those waiting for a big crash, that the rising rents are part of the adjustment that a crash, achieves. And we've already had it, quite a lot of adjustment. So that would be what I would keep in mind.
Can I just add to that?
Yeah.
Also, we've also seen a big rise in investor demand. And I think that reflects the higher yields as well. So investor mortgages have bounced pretty hard. So look, I know there's a lot of stories out there about investors selling up, and we've seen a lot of that. So, and there probably is some investors that bought, during the pandemic, they can't afford the mortgages, are selling out, or they've made some money and they're selling out. But they've been replaced by, it's not quite a record, but it's almost a record number of new investors entering the market. And I think they're doing it because they know that, yields are relatively high, and they see that interest rates have probably peaked and they're going to come down in the next year or so. So I think that reflects pretty much what Cam's just said.
Yeah, exactly. And I think, that is the process that's going to underpin the next construction cycle, right? All those investors that held off during COVID didn't, they were all worried. Now rents are sort of looking better. That wave of shifting money back into Australian investment property is going to support another construction cycle as well. I think it's one and the same process.
The big question, I guess, is, I don't want to take over your podcast, Catherine, but does anybody believe Albo's 240,000 a year, 1.2 million homes over 5 years target? I personally think it is the most delusional thing I've ever seen. But what does everyone else think? And the reason why I say it's delusional is that Australia's record year for housing construction was, I think it was 2017, or if not 2016. And we built 223,600 that year. Yeah. That was Australia. And that's 7% below Albo's target, which he expects to have for 5 consecutive years. Yeah. And the reason why I say it's BS is, back then we had interest rates of 1.5%. We obviously didn't have this massive run up in construction inflation. And we also had obviously a lot of foreign investment into the high-rise dog box apartments that were crappily made, let's be honest, etc. And we didn't have builders competing against big build infrastructure projects, yada, yada, yada. So I think we're going to get a construction uplift, but I just don't think, Albo's target of 240,000 a year is anywhere near realistic. And especially at the moment, right now, as it stands, we're running about a third below that. So we're at about 160,000 dwelling commencements. So, I think that's a bit of a clown show, which sort of tells you that if we're going to have enough housing, you got to cut immigration. Simple as that.
Yeah, I think that. So let's just to help Leith take over your podcast, Catherine. Yeah, you're right. And I think there's a couple of points there. I think you're right that there's the pressure now to actually decrease immigration. That the pushback is happening in Canada, in Australia, in Europe. Uh, people are fed up. There are side effects. I know people think it's taboo to talk about that, but everything in moderation, right?
Yeah.
Not this open doors crazy stuff. So I think that will pull back. On the next construction cycle, you're right. There is a sort of big build public infrastructure sort of program that does compete and constrain construction resources. I'm going to make a prediction. 1 year out of the next 5, we will hit the annualized rate in the target. Just one.
Yeah, we could. It's possible.
And it might actually be the 6th year after. But it'll be like, we'll just hit it, and then that'll be the end of that cycle. Because who's going to build these homes?
It'll be
we
trash
already have something
too.
like 8% of the workforce literally building houses for each other. We're going to have 16%. That's what happened in Ireland before the financial crisis. It was literally 1 in 5 men were building houses for each other. So I don't think it will be that extreme, but we may, I'll be interested to hear what the political sort of story is when we hit that target for 1 year out of 5.
Yeah, and it's possible. I mean, it's always possible, but honestly, I think if we did as well, the quality is going to be crap, because we saw what happened last time. The fact of the matter is, you cannot. It's like when you try and get your house renovated, you can have it done, cheap. There's the 3 rules. You pay a lot of money and you have it done
cheap, fast, and good quality.
That's it. Yeah.
Can't do all 3.
That's it. And we saw what happened last time. We had this big construction boom, 2015 to 2019. The quality was terrible, and we're still paying for it. The New South Wales report came out from their building commission. Like 60% of apartments that were built over that period had, the buildings had serious defaults, and serious defects.
Defects, yeah.
And the fact of the matter is, if we're going to start building this stuff super quickly and just chuck it up like ticky tacky, the quality is going to be compromised. As simple as that. And unfortunately, I think the smarter move is to, slow the inflow of people, so slow the demand, and just build quality and have quality people coming in as well as quality building. Otherwise, we're going to have a repeat of the same garbage we had last time.
Mm. Oh, it's my turn. I've got a little bit to say on this, because that was actually where I was going to head next. So it was kind of good that you wheeled around to that, because, the Victorian government is also talking about, hitting, I think it's 80,000 homes or something this year. So I was reading some articles about this, because obviously working in the housing market, I get to work with a whole range of people that are actually looking for something in the market. And everything that they are focusing on building is high-rise construction. And the way that they've done it, which is Cam's favorite topic, is they've just, they're going to shift all the zoning. That's the only ammunition that they've got in their bucket of ammunition, which is, we'll just change the zoning, we'll fast track these approvals, which is actually what they did in their COVID response as well, which is why we're getting super tall buildings that are currently under construction in Melbourne that are all, sort of like red flashing the skyscraper curse that they're going to open in the downturn, which is typically what happens. And that's simply because they take about 5 years from conception to construction. By the time they open, you're naturally in a downturn. They're built in a bull when the incentives are there, and then by the time they're finished, they open in a downturn, and it just is a great sort of tale of the story of Babel, wanting to build higher and higher. So I'm kind of looking at this, and there's a couple of things that I would say. I've said it before on podcasts, but first of all, unit data that comes out now and again. I hear buyer advocates or property people sort of come out and say, apartment prices are rising because the unit data is rising, right? So they'll look at what unit prices are doing, they'll see a rise. And if you look at unit prices in certain areas of Melbourne, you can see this enormous rise. I remember I can't remember the reporter's name now, calling me from the ABC and saying, why have prices skyrocketed in these posh suburbs where and apartment prices have skyrocketed. And I said, well, the thing with unit data is it's about anything that's on a strata title. So it's not isolated to apartments. It can be villa units, which actually are pretty good investments. And, you know, it can be townhouses, and it can be, you know, a block that's on its own little block of land, but happens to be a strata title because it's a subdivided block. So it kind of lumps a whole heap of data in there. I mean, I can tell you unequivocally that apartments have, over the last, unless you get a very unique one or in a very unique spot, you know, overlooking Sydney Harbour Bay or something, in which case they're already well over 800 to over $1 million. You know, most of them sell around that kind of median price of, you know, 400, 500,000, because they've done nothing but track CPI over the last 10, 20 years. And it's still the same now. And so when they say, okay, we need to provide all these homes for people coming in, they are providing homes for a very small demographic in the market. I think if you dig into ABS data, there's only a small, very small demographic that live in apartments. They're generally renters. They're generally at the beginning stages of their life's journey. I think it peaks out around the age of 27 years. And then they pair up. And when you pair up with a partner, you know, you might be thinking about having a family. You want a little bit more space. You don't want to live in a 1 or 2 bedroom apartment. And that is the home buying market. That's the buying market that is saying, okay, you know, there's not enough properties for our biggest buying demographic, which are families with children or families thinking about having children. And they don't want to live in the outskirts that don't have any infrastructure either. And so this is why, you know, your suburbs, your middle ring suburbs that have the 600, 700 square meter blocks of land, where people are well facilitated with the established schools and the established shopping strips and the nice parks and everything that gives you a healthy lifestyle, which we all value and therefore pay for, you know, that building cycle isn't going to tick up until you get the small home builders saying, yeah, that makes it worth my while subdividing this block and building 2 townhouses. And that's the sector of the market which is really struggling. There's a few that can do it because they're cashed up and they've been in the game long enough and they managed to survive, you know, what happened. But a lot of them have just been knocked out, and, you know, it just doesn't make sense. So I agree in broad, just putting it in a little bit different terms, is that the prime accommodation we're building is going to end up as investment stock. It's going to end up a large part vacant because we're going to oversupply it for the demographic that live in it. And you know, it's the building quality of everything that I have seen over the last year, because I've searched for a couple of people that were insistent on buying apartments. And so we've looked in the modern apartment blocks, and every, you know, owners corporation minutes have flagged water leaks, facade problems, you know, poor building cracking in the concrete cancer in the basement. So there's been, you know, various stuff that's come up like that. So that would be my comment on that. I mean, anyone can chime in, but I'm going to throw something else into the bucket as well for you to chime in with. And that is, you know, I really wonder, because we've had the higher taxes in Melbourne, and because we've had a lowering, you know, everything of that being priced into the market, it could be, I feel we're looking at 2 scenarios. One, all of that has kind of been priced into Melbourne's market. Sydney's market has slowed a bit. The main inflationary markets now are, say, you know, Adelaide and Perth, they're really going up. Could it be that if we don't have a turnaround in Melbourne's market next year, if it doesn't take off or it only moderately turns around because this is still hampering it, could it be that we have a lesser crash at the end of the cycle, or lesser probability of those markets sort of going? Do you remember in the early 1990s, it was really a Melbourne and Sydney story, whereas if you look at the charts for Brisbane, or anyone living in Brisbane would have said, oh, you know, it didn't really impact the market that badly at all, you know, so we've never had a housing crash kind of thing. So that's the other thing that I wanted to levy off onto. So yeah, anything that you want to throw into the bucket of that, Leith.
Yeah, can I, as you said, I'm itching to talk. There's a few things, and this sort of segues back to what you were saying about, you know, the cost of townhouses and whatever in established areas. So I live in the mean streets of Ashburton. I'm joking, it's not mean. It's in Burundara, like a really nice area in Melbourne. And, you know, you can buy basically a detached, good quality house, you know, 3 or 4 bedroom house on a 700 square meter block for probably 2.5 million, right? A good quality one, a good one. And yet, every house that's getting, you know, basically every house that's been developed around here now is getting knocked down and built into 2 or 3 townhouses. So you walk down my street, there's a whole bunch of them. And it's fine, it's good. But the thing about it is those townhouses, I went and checked one out the other day. Yeah, they're sort of flashy and everything, they're brand new, like kind of stuff. But they're at least 2.8 to $3 million. So you literally pay more to live in a half a block new house than you would an established, say, 1940s solid brick house in Ashburton with double the size block. That's still a really good house. It just it doesn't make economic sense. And the other thing about the whole affordability push with high-rise apartments is, I've written on macro business a few times, compared to a few developments going up. So like Box Hill's got 8 towers going up, 8 ginormous, massive, 20 to 40 story towers going up in Box Hill in Melbourne, middle ring suburb. And when you actually look at the project cost for that and you divide it by the number of apartments, they come out at an average build cost of per apartment of $1 million. And this is for apartments. And then there's a whole bunch of other projects which I've sort of analyzed back of the envelope. You just get the total cost, you divide it by the number of apartments. And they all end up being about $1 million. And I'm sort of thinking to myself, okay, so you got to pay $1 million to get an apartment that's, not necessarily a shoebox, but not great. And then you got to pay all the body corporate fees on top of that. On what planet is this affordable? Like, how is that delivering affordable housing? So we're all being told we've got to live in high rise in the future. And it's like, well, but it's not affordable, the stuff that's been built. And we all know that it's going to be probably pretty crappy quality as well. So I'm sort of just wondering what's the end game here? Like, it's expensive to subdivide something and build townhouses. It's super expensive to build these high-rise apartments. None of it is affordable. What's the end game? Anyway, that's just going off on a bit of a tangent. But as you said, the cost of building stuff, like to fill up these middle ring suburbs where families actually want to live, is just not affordable. The $2.8 million for a townhouse, admittedly, it's a nice area, is actually more expensive than buying an established freestanding full-sized house on a 700 square meter block. It just doesn't make sense.
Cam?
That's funny that you raised that, Leith. Do you ever watch? There's a great Melbourne townhouse developer who has a podcast now, and you should interview these people, Catherine. I have to think of their name. Fish something tank something fish development fish. You ever heard of them? And they talk through the feasibility of their townhouses and what they pay for the block, 2 point something million, and that they sell these townhouses for 2.8. And I just think, isn't it weird? You go to all that effort, you had a $2.8 million house, and now you've got $2.8 million townhouses. There must be a strange market where people are willing to pay this premium for brand new.
Yeah.
That's not me. I don't think that's a good investment because you're buying the most depreciating part, right? So you got to really like your modern luxury, I don't know, design rather than your actual investment of the land and the space. But yeah, I have found that interesting. Look, I'm a big fan of townhouses as a general rule, but as we've just said, it's not really that economical in some areas when the homes are worth so much. And I think the point you're making, Leith, that construction is structurally higher now, I think there's another sort of effect to wash through that, yeah, prices will stay relatively high because a lot of the price of construction is incomes of workers. I think a lot of people think construction is like a manufacturing industry, but it's actually more like a service industry because you have to move people to every different site, right? It's just lots of people showing up and working nights to close the street and do the thing. So it's a lot of, incomes in that cost. And so I think that's just another reason that prices won't correct so much, right? Because, you can't build that cost. You can't build for that price and incomes will stay high. So yeah, that's really all I have to add on that. I think the mix, it's, every city complains that they've got the wrong mix of new homes, right? It's too many high rises. There's not enough of this. There's too much of that. I don't know if there's any right answer. People adjust to what's there, right? And I think, we should have some kind of democratic process to inform what we actually want our city to do. And we sometimes miss that. And we're just like, no, density is good for its own sake. And we miss these challenges. For example, a big issue happening now is pensioners in apartment buildings with these huge liabilities for their body corporate and maintenance. So if you own your own detached house, right, and you get on the pension, you don't have to keep your house painted and fixed up, right? You don't have to renovate. You can sort of live off the depreciation of your building. But if you live in a fancy apartment building, you can't do that. You're obliged to chip in and keep that building maintained, right? And so you end up with a lot of pensioners, and it's going to become a growing issue, can't afford to stay in apartments, right? So they have to move out of the city because they have to actually live in a house where they can just sort of let it degrade while they're on the pension. Yeah, so keep your eye out for that as a sort of upcoming issue that I think we don't talk about enough when it comes to what types of homes are we building, and are they a good enough quality, or are we, do we have all these hidden defect liabilities for these apartment owners? And we're trying to encourage pensioners to downsize to these, right? So that's going to be a sort of growing issue, and I'm not sure exactly how we'll sort of deal with that, or whether pensioners will just stop buying apartments and avoid them.
Sorry. You go. No, it's your podcast, Catherine. You go. I don't take it over.
I'm going to come back. I'll come back to you, Lee, because I was just going to pipe into two or three things that you've said, throw something else into the mix on that. I don't know how, having handled a few developments over the course of my real estate career, I actually don't think if you're buying the block of land needs to be about 20% as a general rule cheaper than the end value of the two townhouses that you build to make it anything worthwhile of a profit. That, unless you're not having to go to the bank and borrow the money, unless you're cashed up to do that development out of your own pocket, and then you probably can get around those types of things as well. So it's just not profitable. And the reason that developers focus on those quality areas is because they need a buyer market that's going to pay a high price for what they develop. They don't want to build in an area where it's a different buying market, where they're foot through the door buyers. They want a market where people are going to pay a price for the new townhouse. And of course, townhouses actually aren't that great quality. The other thing about them, they're not great investments either. They have a limited buyer market themselves because they're professionals or smaller families that don't want that backyard. They knock out the downsizers. And the downsizers are often cashed up. They're selling a expensive property. Now, in my experience, and I'm pretty sure the data backs this up, but there's not a flood of downsizers into apartments. And that's generally because they want to downsize their land size, and they want to downsize, have some money in the bank. But they also have a house full of furniture, perhaps some grandkids that they want to come and stay at some point. They also have, a quality of life that perhaps a smallish apartment isn't going to give them, especially if it's got high owners corporation fees, which is going to eat into that budget each year. So I find that they prefer sort of like a single level town residence, whether that's a villa unit, a nice quality villa unit, a town residence on its own block of land. Perhaps they'll move out a little bit to reduce costs. But interestingly enough, I have a subscriber that has purchased a property in one of the lend-lease communities, the retirement communities in Queensland. And he was telling me that he purchased it, and I'm sorry I cannot remember the figures, but he purchased it for an amount during COVID. They decided they were going to move in there. The facilities are unbelievable. By the time we'd finished talking to me about it, I was almost ready to move in myself. It's just like bend the rules and let me get through the door or something. But the facilities are amazing. It's in an amazing location. They've absolutely loved it. But because there's such a high demand, the value of their property, of which they own completely, has skyrocketed over the last few years. And his question to me was, well, do they sell out at the peak? Do we hold on to it? What do we do with it? Because it's actually turned out to be a really good investment. So I wonder whether, because we're not building these kind of single level town residences, which is where downsizers really want to be within their communities still, but in a smaller property, but still, something that can accommodate their lifestyle needs, whether these communities are going to continue to, be dominant in the market. Interested in your opinion on that.
Well, it's scarcity, isn't it? So, if we're going to be oversupplied with high-rise shoeboxes and undersupplied in, single detached houses and those sorts of places that you just mentioned. Those things that are undersupplied in is going to, or become relatively scarce, are going to, have stronger value growth. I think that's, pretty much what you're getting at there. Like it sounds from what you've said, it sounds like they're fairly scarce and they're fairly rare, and there's not too many of those sorts of high quality properties around. So they're going to be in demand and they're going to, fetch a premium. I think that's pretty much where we're at. And I can see the same with, large detached houses on large blocks if you live in a place like Sydney or Melbourne, because, like take Melbourne, for example. Melbourne's population was 3.5 million at the turn of the century. It's forecast to get to 9 million by 2056. So that's 5.5 million in just 56 years. That's the official forecast. That means we're going to have massive density. And it means that if you have a single detached house in a middle ring area, or, on a big block that's a decent quality house, that's going to become very scarce, relative to the other forms of housing stock. Same in Sydney. So, I think the thing you're talking about is just, a bit of scarcity. There's not too many of those things, so they become very valuable.
And the stock price has done very well. I might just add on that over the last few years. Cam.
Yeah, those land lease communities are, I think they've understood the needs of the downsizer well, that it's low rise, lots of community facilities, but not a very big building and no yard. Now, the benefit for the property owner or developer of these communities is that means you can get multiple times as many dwellings on your site, right? The other thing is because it's a sort of group title or a strata of some form, you don't have to build actual street quality streets, right? You can just build driveways to all these. So again, you're shrinking the amount of land you need. So they end up being quite high density, one story. They're like caravan parks, right? But instead of a caravan, you have, a demountable. And in fact, I think the legislation's changed, but it used to be that the building had to be removable to qualify for what is essentially a bit of a tax dodge. So I'm not sure if you're aware, the land lease scheme, you don't actually buy a title, you buy what do they call it? You buy a contract, basically, like a private contract. You buy a rental contract. And so you rent. Instead of paying body corporate, all those fees are bundled into a site rent that you pay instead of a body corporate fee. And you own this contract. So because you're not buying a title, you avoid stamp duty. You pay rent, which means if you're an age pensioner, guess what? You get rental assistance, even though you own your own home. So you kind of get the best of both worlds. You're a homeowner because you own this contract, but you also get rent assistance because the contract requires you to pay rent instead of body corporate fees. So it's essentially this arbitrage game of navigating. Oh, if we sell a contract, not a title, we avoid stamp duty. Oh, if we call it a rent, not a body corporate fee, all the pensioners can get rental assistance. Oh, if it's not a subdivided, we have lower infrastructure fees because we don't qualify as 100 detached homes. We're actually one sort of caravan park, which has lower fees. So it navigates all these sort of loopholes, and at the end of the day, you end up with this strange situation where the owner has an interest in putting the rents up on the tenants as much as they can because that's what their return is like. And so it's been the last sort of 15 years, there's been a lot of battles and there's been updated legislation to rent control them because these retirees who've cashed up, they've sold the house, they get in, they go, oh, this is cheap. Oh, and I get rent assistance with my pension. Let's do this. Not knowing that the guys will put the rent up every couple of years, right? As the rent assistance goes up, they get more. As your pension goes up, they get more, right? So it's a little bit of an odd business model. And I think there's a real risk. So if anyone's thinking of investing into this, I think Stockland is now the biggest land lease landlord. They've bought up a couple of the smaller players. I think there's a big regulatory risk here, that the rules might change, that all your tenants won't get their fortnightly couple $100 rent assistance that goes into your pocket anymore. Then what are you going to charge them, right? $50 instead of 200, that's 75% of your revenue gone as a landlord for these things. So yeah, it's I think that what they've done really well is understand the physical needs of the downsizer, low rise, small, good community, great facilities, all that. They've done really well with navigating all the loopholes through the tax system. But I think, as a business model, I think there's a lot of regulatory risk.
Mm.
Anyway,
I
that's
have
my
to,
rant.
yeah,
That's interesting, Cam, because I actually knew none of that about how these work, and now I actually know it. So thanks very much.
Well, I had a Substack earlier this year, the
I
massive
must I
deep
must have missed
dive
that one. I
into
do read
this.
your stuff,
Yeah.
so I must
Fresh
have missed that
economic
one.
thinking. Anyone listening, look up land lease communities or just land lease on Fresh Economic Thinking, and you'll get the deep dive into all those issues.
he did tell me that there was, because I questioned how much does, the lease payment go up, and he said that there was controls over it, or there was something written into the contract about, how much it would go up. I think that there is some kind of oversight. I mean,
There
obviously
is now, yeah, that's right. So each state now has a limit on how quickly they can put the rents up. But so for example, if you Google this, you'll find reporting that the rents have gone up from like 125 a week to 210 a week. Right, so you're an age pensioner, and all of a sudden you got an extra sort of $85 a week in cost. But what do you do? Where do you go? Right, because you either give up your rent assistance and you pay the stamp duty to make a move, or so some people do end up getting stuck. And I've interviewed quite a few people who live in these places, and it's not for everyone. It's very close. Like, yes, you get a single detached house on one level, but it's literally you can reach out the window and shake hands with next door, right? Because they're packed in. So yeah, and there's some really interesting ones that have like double height garages, so you can put your caravan in and all that sort of stuff. Really, like the design is really custom made for downsizers, and so that's what I think makes it very attractive as well.
What about my forecasts for Melbourne? I mean, I feel kind of like it's two-pronged. I certainly feel that Melbourne's primed for the market to turn.
I agree.
Seeing a little bit of that on the ground, to be honest, and just a hint of it. There's not a massive amount of stock available. There is a lot of people that are looking. There's no FOMO in the market to really push it to take off quite yet. But it kind of like is one of those inevitable things. We have a little bit more security about rate rises. We have all of the tax changes. I feel that they've been priced into the market now. We have a very strong first home buyer market coming in. We still have very strong population growth coming in. Still have a shortage of quality accommodation. So though I'm not sort of saying that apartment prices are about to take off, certainly in terms of the property prices. And, I property shop for clients over a broad and wide area. So I get to drive into all sorts of inner and outer ring suburbs and regional areas through the week, and, get a sense of what's going on the ground. And I can tell you that there's some pretty heated competition for properties that are, not well priced compared to where the Melbourne medium is. So I'm talking about places like Laylaw and Thomastown, for example, which are about 17 kilometres north of Melbourne, suburbia. Their property prices are probably around 700, 800,000 there. And there's pretty good demand, right now for it. So, but if we don't get like a real bullish turn, could that kind of moderate as well? That's the other thing that I've kind of thought about. Has Melbourne kind of done the right thing now and moderated the impact of any property market crash?
I think you're right, Catherine. So basically, I'll take my house for example. My house has had zero increase in value in about 5 years. So the reason why I say, whether you use the realestate.com, whatever, median estimate for my house, it's been at the same level for 5 years, and I've seen that all around the area. So basically, but I live in a sort of nicer area, but those sort of properties have had no increase. Like they went up a bit and then down a bit and whatever. And Melbourne, it sort of seems strange to say, but Melbourne's now become relatively affordable. So I don't mean it's necessarily affordable in an absolute sense, but we've got a situation whereby it's basically treated water for years, and at the same time as the rest of the country's, shot up like a bullet, especially, Brisbane, Adelaide, Perth, etc. and Sydney as well for a period. And as a result, Melbourne's, looking relatively affordable to other places. We've still got, we're going to have massive population growth in Melbourne, even if they cut migration a bit. It seems to be the leader of population growth. And as a result, that means that, Melbourne will be primed to turn around because it is a bit like Brisbane was. Cam will be able to attest to this. Brisbane was flat for years. And then, everyone kind of realised that Brisbane was super good value and they piled in. Melbourne's going to have probably that kind of scenario. And if not, if we have a generalised correction in 2 years or something across the nation, if Melbourne doesn't have a big catch-up growth, we probably won't have as big a decline as other places because we haven't had that run-up. So
talk about our economy as well, Leith.
Oh, the economy, look, the economy in Melbourne's a basket case. It's a bit of a joke. But and I was saying to Cam yesterday on the phone, I was having a laugh saying Melbourne, Victoria is basically turning into a failed state, which I actually believe. Credit rating's terrible, government debt's massive. We've got oodles of waste on just ridiculous projects, etc. And it's a bit of a look. The economy's not great, but we're going to continue to get strong population growth here from overseas, etc. And as a result, I think the property markets here will turn around, and it'll probably have a period where it outperforms other areas of the country. I don't know whether that's next year, or the year after, or whatever. But we've had this prolonged period where it's underperformed. Valuations elsewhere, like the median house price and dwelling price is now less than Brisbane in Melbourne, which I thought I'd never see. And that to me doesn't make a whole lot of sense given the size of the cities and all this other stuff. No shade at Brisbane, good spot. But it's just the run up in values there has just been so massive in Brisbane that now that's looking a bit toppy to me. Whereas Melbourne's has had this no growth for years, effectively, and that'll protect it on the downside if we have a generalised national housing downturn. But it should also mean that over a period of, say, the next 5 years, Melbourne will probably outperform because it's had a period of underperformance. Just, mean reversion, I guess, is if you want to call it that.
Cam?
Yeah, I think that's totally right. I think places like Brisbane and the Gold Coast, I don't know if the Olympic hype will keep things going long enough. But yeah, you're right. Melbourne's sort of, I'm just looking at the data, the prices have not boomed like any other place the last 8 years, whereas Brisbane's just launched, and yields have actually come down in Brisbane, whereas they're actually reasonably high in Melbourne. So yeah, that makes a lot of sense to me. The correction, whatever correction we get in the next couple of years, when we sort of Australia enters this slow and broad recession that's happening everywhere, it's definitely going to be uneven. And I think places like Perth, Gold Coast, Brisbane, Adelaide, that really boomed sharply will correct more sharply, and places like Perth, places like Melbourne, might just plod along.
Yeah,
that makes total sense.
Can I ask a question to Catherine? Because you look at the Perth market. My view is on Perth, it'll probably do all right, maybe next year, but I think Perth's going to have another bust. So it seems to be a really boom bust market there, and it seems to be very much related to the commodity market. And the iron ore market's looking very toppy now because prices are falling, Chinese demand, etc. And also there's a massive iron ore mine opening up in Africa next year, which is going to just pump the global supply of iron ore. It's called Sinandu. I hope I pronounced that right, in Africa, and it's going to dump 100 million tonnes into the market. So, what do you think will happen to Perth? Because Perth's obviously had a ginormous 70% run up after years of where it underperformed when the last commodity cycle. So it's doing catch-up growth now. It's still relatively cheap on a national basis. But in a year or so, do you think it'll then go through another bust? Because it seems that if you look at it, it's a very volatile market. And we're obviously in an upswing right now. It's going really aggressive. In, say, 12 months' time, do you think if the iron ore price does tank or continues to tank, do you think Perth will then go through a correction phase?
Yeah. I mean, if you look back at Perth's history of property booms and busts, you've obviously got the boom into 2008 where median prices peaked out for a very short period of time past where Sydney's medium was, and because it was all news at the time, which is very similar to kind of what's happening now. You know, you're seeing Adelaide and these other markets sort of take off, as well as Perth, you know, where they're saying that, and Brisbane, you know, I think the median price in Brisbane has just outpaced Melbourne, and so you're seeing that all over the headlines. If you look historically, though, back before that, the only time that Perth really did take off was when it had mining investment, and so you can go back to the 1890s when they started to subdivide land in Subiaco, you know, because while everyone else was crashing, you know, they were finding gold on the ground in Perth. And so they had this massive population influx, and their economy kind of thrived through that downturn, which was an incredibly bad property downturn, very tragic for Australia, worse than the 1930s. But if you look at it also from a cyclical point of view, and this is why I really feel that we have to start taking cycles into our analysis, because otherwise we're analysing on fundamentals, and the fundamentals can change tomorrow. Like, I think, Cam, you say this, which I think is so good, which is you're on a trajectory, and if you mistakenly take that trajectory another 10 years into the future, you're not, you know, you're forecasting based on where we are now, not necessarily based on where we're going to be in 5 years. And the two things that really show really dramatically in Australia over, you know, we've correlated with this 18-year cycle over the past 3 cycles between the 1950s to early 1970s, the 1973-74 downturn, 1974 to 1991 downturn, 1991 to the 2008, which we managed to buffer with policy, and now 2008 to around 2026, 27, where you would be expecting another downturn. And there is a specific pattern that plays out in our local property markets based on that cycle. They were all 18 years. It was pretty much like clockwork. You only need to count it on your fingers. But the way that they played out was smaller states, smaller capitals, I should say, because this is this is where population growth, this is where the dynamics happen that push prices up. So the smaller capitals by population go nowhere in the first half of that cycle. You can chart that back, and you can see it at least back to the, you know, between the 1970s and 1990s to 2008. Beginning of this cycle, we could say was between 2012 and 2017. Prices started to increase around mid 2012. They went up to a peak in 2017, came back a bit because of the Royal Commission, and then boomed into where we saw in COVID. And during that time, the median price in Brisbane, Perth, and, you know, Adelaide and Hobart and, you know, Darwin, Canberra was going nowhere. You get to the second half, and my analysis over that time was saying, based on nothing fundamental showing, just based on cycle analysis, we're going to have those states will start taking off in the second half of the cycle. And lo and behold, we get to the second half and you see it happening. But that doesn't mean that they're not going to be impacted by the downturn, because the downturn is a financial crisis. It's because the banks lend predominantly against land as collateral, whether it be for a business loan or a mortgage. And so, you know, when you get the buyer market that drops out of the market, then you have to have a downturn, and the places that have boomed most will have the bust. And because also we're on this upwave of a Kondratiev cycle. Now, Kondratiev cycles are much longer. They're around 25 years up, 25 years down. But what happens to the end of that cycle is you get a lot of competition for the commodity that is fueling the next energy thing, you know, whether it's steam engines, electricity, you know, you see the canals, the steam engine, the electricity, you know, now we're onto this kind of green energy. And so there's a lot of demand, a lot of building activity, a lot of real estate stuff going on. And then you get an increase in supply. The infrastructure has been built out, the plan for the 2030 net zero. You've got all your wind farms and all that kind of energy intensive stuff, material intensive stuff has been built out, and the demand goes out of the market. And so you're looking at Perth having, based on those two cycles, an extended downturn. Now, if we see that and we recognize, okay, there's nothing to stop this cycle continuing to play out, we've got a good deal of history for it, we know how it plays out in the local market, then you're going to say, okay, you know, those places are going to have a bust. There might not be the demand for mining. How harsh that bust is going to be is somewhat dependent on government policy, because governments can, you know, spend their way out of a crisis to some extent. And so that's kind of how I see it. And the only other thing I'd probably say is, you know, in terms of what happens in those downturns, I mean, I've worked in, you know, the Australian property market for a long time. Almost don't want to say how long, kind of gives too much away. But I remember the 2008 downturn, and I was working for a different buyer advocacy company at the time, which I absolutely loved. I loved my job there. It was a family company, and the buyers exited like that. They all stopped buying because of what was happening, to the markets. That it's so sudden that when you get those black swan things that finally trigger whatever is going to happen at the end, whatever it is, whether, then it really is kind of like that sudden. So that's how I see it. I think history has proven that with Perth that it's boom bust, but I also think that there's a cycle element too that's kind of clarifying it as well.
Yeah.
Are we there?
We'll have to talk more about cycles next time in this Quantitative cycle for sure.
Yeah, there's so much to talk about. I mean, there's so many more things that we could talk about in this discussion, NDIS and other policies that we've got going on. But I think we've given a good overview that basically says none of us are really expecting a significant market crash next year. No. There is a recession of sorts going on in the economy because of how the dynamics of this cycle has played out, but we're not seeing a crash in housing markets happening all of a sudden for all the reasons that we've said. So it only leads me to say, Leith, the TV star, the TV media mogul, who runs Macro Business, you can find you at macrobusiness.com.au.
That's right. And also at YouTube now, I've got a YouTube channel. It's it's one of these rando things I just sort of started up to try and just put all my media appearances on. So I got a record of it. So it's at Leithvo, Leithvo. It's actually creeping up to nearly 8,000 subscribers now. So it's bizarre. It's now become kind of popular. So it's anyway. So get me macrobusiness.com.au and YouTube at Leithvo. That's really just my media interviews that I do. I just put them on there. And also I do the odd explainer video. So had one recently on the $48 billion international student export rort and a couple other ones like that, just trying to, take down a few myths, etc. So that's me.
And I want to say just in regard to, I want to sort of make this really clear to watchers, is that the information that you get from Leith and that you get from Cam, you're not going to get anywhere else in Australia. They're coming out. The reason, obviously, that Leith, you've taken off so much as a media commentator is because you're putting out information that is based, that it has a solid economic narrative behind it and gives a very truthful opinion outside of the spin that we normally get. So definitely worth checking out those. And Cameron, where can people find you?
Yeah, the best place is fresheconomicthinking.com. It's my one-man think tank / newsletter. You can subscribe for free, put your email in there, or pay to support me and get all the in-depth articles. And another great place to find me is on Twitter or X, Dr. Cameron Murray, Dr. Cameron Murray, all one word. And I put up daily, thoughts, charts, interesting observations.
Yeah. Mate, I'll just say Cam's the smartest economist in the country. So if you're not following him, get on him. He's unconventional, but he's also incredibly smart, and he looks at stuff from angles which pretty much no one else does. And most importantly, he's honest. So I have to say most economists in Australia, quite frankly, paid shills. So and Cam's not one of those guys. So get on it.
Yeah, I think that's actually funny you say. I appreciate that, and I'll sort you out later, Leith. But this is one of the things I've found as an economist. It's very hard, even in academia, to find somewhere where you are intellectually free to be honest and just follow the logic and the evidence. Academia has its tribes and its culture. So yeah, I'm really trying to carve out that niche and not really have too much commitment from different financial interests, but be supported from the readers who are like-minded. And they're like, I want to see what an objective person thinks when they evaluate the evidence and they're not sort of pushing an agenda. So that's what I'm trying to do. So I appreciate the kind words, mate.
Yeah, no, that's great. And obviously I'm a subscriber to you both. And Cam also does some excellent research for Prosper Australia, which I'm always advocating we should delve into the research there because helps our knowledge. But thanks so much, both of you, and we will catch up again soon.
Thanks, Catherine.
No worries, Catherine. Speak to you next time. See you, Kev.
Bye, mate.